When I started trading initially, the journey was not easy for me. Mostly because in the world of stock market, there are so many difficult terms and words. I couldn't understand them at all. And I know the journey is very similar for you as well, right? You started learning, you started reading other material as well. I'm sure you're also not understanding a lot of terms. In that case, this video is for you. Hey all, welcome to the 10th video of the complete learning series of stock market investing and trading. As always, I put all the videos into a playlist. The playlist is available right here. Make sure you watch all the videos in the right order and learn really well. Let's all learn together and grow together. So as I said, since you started learning, whatever videos you saw so far have been theoretical and practical videos. Now you're all set to learn more advanced and complex materials, right? Like fundamental analysis, technical analysis, and futures and options. Yes, this is the last video of the so-called introduction and orientation. From the very next video, we are going to learn complex stuff. So before getting into that, I really believe that you should know all the basic but common terms which are used in the world of stock market, and that's exactly what we are going to do in the video. Not a long intro at all. That is the agenda. We are going to discuss nearly 40 terms which are used on a daily basis by every stock market participant. So super important to know all of them. So one disclosure up ahead is that I'll be quickly going to discuss all these 40 different terms. So hear it out once and then maybe Google each of those terms and read more about them. I'm sure you're going to understand. So yeah, without further ado, let's get right into the video. The name is Shah Shamsuddin. Welcome to Market Feed. So yeah, this is going to be a sweet video which will act as a dictionary kind of a thing for you, because as I said in the introduction, we are going to learn a lot of basic terms in the world of stock market. Now for a beginner, when he starts learning about the stock market, he learns from some YouTube videos or somewhere, and then he goes into groups of people who are discussing about the stock market. Now the problem there is that all these people would be using these terms and jargons in their sentences, and a beginner wouldn't understand them at all, and this beginner would feel intimidated and scared. Now that is the agenda of this video. In this video, we will be learning all those terms and jargons so that when you go into such groups, you can start using these words in your own sentences. And also, when you learn more about the market, all these terms are definitely going to help you. So one ask from you is the fact that when you learn from this video, after learning all these terms and jargons, make sure that you Google as well. Google about the same terms and read a bit about them. You'll understand even better. You'll become a great learner about the stock market. Cool? Then let's start learning. And speaking about starting learning, as you see here, we have a presentation from which we will learn today. Yes. So the presentation is not just in this video. Going ahead, when we will be learning fundamental analysis, technical analysis, we'll be using presentation. So it will make our learning much easier. And also a very interesting fact is the fact that after the video, I'll give a link to download the presentation in the pinned comment and the description. Make sure you watch the video, learn from the video, download the presentation and learn even better. If all set, let's get started. So as you can see here, this is the title card which says basic stock market terms. So that is exactly what we are going to learn in today's video. And this is the first term that we are going to learn. Stock market, because why not, right? So before learning about the terms, let me explain you the structure of the presentation. In each slide, the term that we are learning will be given like this in bold at the top. Below which we can see in the bullet point, the description of the term would be given. And finally, I'm also giving a special segment called used in a sentence. That is, whichever term that we are learning, I'm going to use it in a sentence as an example so that you can understand it even better. So the first term here is stock market. Now I know almost all of you know what the term stock market is, so let us quickly go through it. It is the place for trading stocks and other securities. Now if you need a near 50 minutes explanation of the same, you can make sure that you watch this video given here, right? Now used in a sentence here as, I trade in the stock market for an extra income. Very clear, right? Let's quickly move ahead into the next term, which is market segments. Now, this is very important because a lot of beginners who come into the world of stock market, they invest and trade in stocks only. Stocks or equity, right? And they think that that is all that is there to the world of stock market, but that is wrong. There are different market segments when it comes to the stock market. They are, as you can see here, cash market, derivative market, and debt or money market. Now, what are these? If you're trading or investing only in stocks and equities, it means that you're participating in the cash market. Cash market. Now, derivatives market is the market segment where you trade in futures and options. Now, I know you don't know what futures and options are, but no worries. Going ahead in the series, we will learn about futures and options. And finally, it is a debt or money market. That is, if you invest or trade in bonds or debentures, yes, these are debt instruments. We'll learn about those also going ahead. No worries. So these are debt instruments. So if you're trading in the debt instruments, that is called the market segment of debt or money market. I hope that is clear. Now, used in a sentence here as I invest in the cash market, right? I buy stocks, I invest in stocks or equities, and I trade in the derivatives market because I am predominantly an option seller, an index option seller. So I trade in the derivatives market. Moving ahead, the next term here is marketplace. Yes, normally when we think about marketplace, we only think about companies which goes IPO and goes public, and we think about us who participate in the market. But that is not all, right? There are four major marketplaces that we should understand. Number one is promoters. Number two is retail participants. Number three is FIIs, and number four is DIIs. So let us learn about them. Number one, as you can see here, is promoters. Let's read about them. Promoters are people who have control over the company affairs directly or indirectly. Very clear, right? So to understand it even better, promoters are people who founded the company or people part of the founding family. They have a direct or indirect control over the company. Now let's take an example. Reliance Industries Limited. We all know Reliance, right? Who are the promoters of Reliance? Mukesh Ambani and his family, right? So as easy as that. Now let's talk about retailers. Now retailers, let's not even read the description there. It's very easy to understand. Retailers are people like you and me. Normal individual people all across the country who are investing and trading in the market. So we are all retail participants, or in short, we are all called retailers. Cool. Now let's move ahead to understand about foreign institutional investors. Now before understanding FIIs, which is foreign institutional investors, and DIIs, which is domestic institutional investors, let us understand what an institutional investor is. Now an institutional investor is a corporate entity, right? It is a company whose primary activity is to invest and trade in the market and to make money. Cool. That is what an institutional investor is. Now, if you understand what an institutional investor is, it's very easy, right? Foreign institutional investor is a foreign corporate entity who wants to invest and trade in India to make money. As you can see here, investor or investment fund investing in India from outside of India. Now, used in a sentence as the government of Singapore is one of the largest FIIs in India. Cool. Then DIS is very, very easy, right? Domestic institutional investors are domestic corporate entities investing in India. Used in a sentence as LIC is India's largest domestic institutional investors. LIC, right? Life Insurance Corporation of India. Now moving ahead into the next term, which is sectors. Now we know there are thousands of companies which are listed in the stock market, and each of the company has a specific business that it runs. But each of these businesses can be categorized into verticals or segments, right? That's exactly what sectors are. Stocks are grouped into sectors based on their business segment. For example, we can see there are different sectors like banks, IT companies, FMCG companies, and so on. For example, if you take TCS, or Infosys or Tech Mahindra or Wipro, all of these are IT services companies. So we can all put them together and say that is one sector, which is the IT sector. Just like that, we have the banking sector, the pharma sector, the FMCG sector, and so on. Now, used in a sentence here as IT sector has shown phenomenally high growth in the last decade. Very clear? Let's move ahead. The next term we are going to learn is stock symbol. Now, this is a term probably a lot of you know already, right? As you can see here, it is a short form used to uniquely identify a particular stock in the stock market. Now, the names of companies can be very large and long. Now, to use them in your conversations very easily, and to show them on the broker's terminal is kind of difficult. That is where a short form is used. Like for example, as you can see here, TCS is the stock symbol of Tata Consultancy Services, and in the use sentence also you can say Infi is the stock symbol of Infosys Limited. So again, it is a short form used to uniquely depict a company's name. Moving ahead, the next term we are learning is outstanding shares. Now we all know that when a company goes public, it issues its shares to public shareholders. So we all know what shares or equity are, but there are different types of shares that we should definitely understand. Number one among that is outstanding shares. What are they? These are the total number of shares that are issued by the company to shareholders, including promoters. The including promoters is very, very important. Now let's move ahead and even understand what public float is. When we understand this, you'll have a better understanding of what outstanding shares are. Okay, so public float is the total number of shares that are available for public investors to buy and sell. That is the total number of shares that are available for public investors, both retail and institutional, to buy and sell. What is the formula here? Public float is equal to outstanding shares minus locked in shares. Locked in shares, what are they? That is where we have to come back to outstanding shares. So here we have seen that there are shares owned by or held by promoters as well, and among these shares there are some amount of shares which are locked in. The promoters cannot buy or sell them in the open market, and that is the reason why public float is equal to outstanding shares minus locked in shares. That is, public float means the total number of shares that are available for public investors to buy and sell. Next, let's learn about face value. Now, face value is the value of one share of the company as listed in its share certificates. If you read here, you can understand that face value of a share of a company is decided during formation of the company, and it does not move on a daily basis. It moves sometimes, it is changed during certain corporate actions. These corporate actions are something that we learn going ahead, need not be worried at all. The used in a sentence here as the face value of Reliance is rupees 10, even though it is trading at rupees 2,500. Do you understand that? The stock price of Reliance, if someone asks you, what would you say? You'll go into your broker's terminal, you look into Reliance's price, and you will say, okay, the share price of Reliance is 2,500. But then Reliance has something also called as face value per share, and that is still rupees 10. I hope you understand that. Then let's move ahead to the next term, which is very interesting, which is the market value or share price. Now, this is what you see on your broker's terminal, right? The current trading price of the share in the open market is the market value or the share price of a stock. Now, that is exactly the same as LTP, last traded price, or CMP, current market price. Now, I see in the initial days, some people get confused between market value and face value. That is why I'm explaining this. Face value is decided in the initial days. It is normally 5-10 rupees kind of thing. And the share value or the market value is actually the price that you see on the broker's terminal. Now, the use in the sentence here is the share price of Reliance or the market value of Reliance or the LTP of Reliance or the CMP of Reliance is rupees 2,500. That is where we come to a very, very, very important term that all beginners should definitely understand, which is market capitalization. In short, this is called market cap. I'm sure you would have heard this somewhere. Now, market cap is the total value of all the company's issued shares. Or in simple words, it could be said that market capitalization is the market valuation of a company. Right? Basically, valuation of the company. Now, what is the formula of market cap? Market cap is equal to current share price, which is the LTP, or the previous slide we learned, right? Market value or share price. So current share price into total outstanding shares. That is basically what you're doing is you're taking the current market price of the company, you're multiplying it with the total number of outstanding shares, and obviously you'll get the valuation of the company, and that is called market cap or market capitalization. Now, used in a sentence here as market cap of Reliance is more than rupees 15 lakh crores. Which means that valuation of Reliance is nearly 15 lakh crore rupees. That is, in very, very simple words, if you would like to buy Reliance as of today, if you want to buy Reliance today, you have to spend 15 lakh crores. You pay that much money, you can buy shares from all the shareholders and 100% Reliance will be with you. Right? So market capitalization is kind of the valuation of the company itself. Moving ahead, based on market capitalization. All the different companies in the stock market are divided or differentiated into different segments. Let's learn about those segments. I'm sure you would have heard about these segments as well. Large cap stocks, mid cap stocks, small cap stocks, right? You would have heard. Otherwise, let's learn now. Now, let's first learn about large cap stocks. Now, large cap stocks are stocks of large cap companies. And what are large cap companies? These are the top 100 listed companies in India. And how do you ensure which are the top 100 companies? Top 100 companies by valuation or market capitalization, right? So stocks of first to 100 largest market cap companies in India are called large cap companies, and the stocks of these companies are called large cap stocks. Now, before we move ahead to learn about mid-cap stocks, we should also learn about this term, which is blue chip stocks. Again, very important. I'm sure you'll hear about the same term in a lot of conversations. Now, blue chip stocks, if you read here, these are shares of the biggest large cap companies which are well recognized and have a long history of good financial performance. Now, if you read used in a sentence here, you'll understand better. Adani Enterprises. You have all heard about Adani Enterprises. Adani Enterprises is a large cap company because it is among the top 100 listed companies in India. But Reliance is a blue chip company or a blue chip stock. Now, what you can easily understand is the fact that all blue chip stocks are large cap stocks, but all large cap stocks are not blue chip stocks. Cool? Then let's move ahead and understand mid cap stocks. Now, mid cap companies are the next 150 large companies in India. That is, stocks of 101st to 250th largest market cap companies are called mid cap stocks. So then what are small cap stocks? Very easy, right? All the other companies stocks we can basically call small cap stocks. Basically stocks of 251st largest market companies onwards. That's very important. Now, if you see used in a sentence here, TVS Motors is a mid-cap stock while India Cements is a small-cap stock. I'll give a link in the description. If you go to the link, you can easily see which are the large-cap companies in India, which are the mid-cap companies in India, and which are the small-cap companies in India as of today. Now, before we move ahead to other terms, this is one term you all should definitely know. And I'm sure all beginners are mostly interested in penny stocks even before they are interested in blue chip stocks, right? That's a sad reality of the stock market. Now, let's understand what penny stock is. Penny stock is usually a small cap company with low share price and poor financial performance. But there are two things to it, right? Normally, this is the actual literal definition of a penny stock. But normally when we see beginners, whichever company whose share price is below 20 rupees or 10 rupees, people call it a penny stock. But literally, or to be very theoretically right, penny stock has to have a very low share price, like 5 rupees, 10 rupees, 50 rupees share price, and it should have a poor financial performance also. Anyways, used in a sentence here as Dish TV is a penny stock because its share price is only rupees 12. Now again, one word of caution here is, I've seen a lot of beginners coming into the market and putting their money into penny stock because they feel that when buying a penny stock for 2 rupees, the chances for it to move from 2 to 4 rupees, that is the chances of doubling the share price is much higher. And I also feel that beginners feel that when they are buying a share of a price of just 2 rupees, even if they have 20,000 rupees, they are basically buying 10,000 quantities and they feel good. Okay, now I am also an owner of the company, right? So please don't get into the trap of getting trapped in penny stocks. So please be very wise. I would always say that blue chip stocks or large cap stocks are the best place to invest in the initial days, right? The next term we are learning is annual report. As you can see here, annual report is a comprehensive report of a company's activities and financials of the previous years. It's a document, it's a 300-400 page document which a company publishes and sends to all shareholders, and it puts it out in the public as well. We can always download the annual report of company, read about the company and understand if the company is doing well or not. So going ahead, when we learn about fundamental analysis, we'll actually download annual reports of companies, read annual report and learn everything about the company. Their business model, how they have been doing, their financial statements, their P&L statement, cash flow statement, balance sheet, everything is available to the public. And to me, it is something very exciting. You can actually download the annual report of Reliance Industries Limited and understand every number about their company. How amazing is that? The same can be done for the thousands of companies which are listed in the stock market. Amazing, right? Now, as you can see, the second point, annual report is a mandatory requirement to be submitted to all shareholders. The use in a sentence here is, in its annual report, Reliance said Jio helped it increase its profit 2x. Amazing, right? So just like this, all critical business information about a company could be found in the annual report of the company. Moving ahead, a very familiar term again, right? IPO, initial public offering. Now, IPO is the method or is the process with which companies go public and raise money from outside investors, both retail and institutional. Very important to understand this, right? When a company goes public, they are raising money not just from retailers like us, but they raise money from institutional investors as well. Used in a sentence as Swiggy. I hope you all know Swiggy, right? Swiggy is a privately held company today. Now, Swiggy is planning to do their IPO this year itself. Moving ahead, let's understand about primary market and secondary market. Primary market refers to share transactions between the issuing company and the public investor. That is, during the IPO of a company, a public investor, let it be a retail investor like me, I am paying money to the issuing company and the issuing company is giving the share to me. The transaction is happening between the issuing company and a retail or a public investor like me. This transaction is called a primary market transaction. Next, let's understand about secondary market transaction. This refers to share transaction between a public shareholder to another public shareholder. Say IPO of the company is done. Some 1 year later, I want to sell the share that I bought during IPO. Who would buy the share from me? Some other public investor, right? So he would pay me money and I would give my share to him. So the transaction is happening between a public investor to another public investor. Now this is called a secondary market transaction. The company, the issuing company, has nothing to do with this when it comes to a secondary market transaction. The next term we should understand is dividend. I hope you all have a basic understanding of what dividend is. Dividend is basically a company distributing a part of the profit back to its shareholders. A part of the profit. Now, this is purely discretionary. Say a company made profits of 1 lakh crores a year. Now, it's up to the company to decide if it wants to distribute back 1 lakh crores profits back to its shareholders or just 1,000 crores from it. So, it is up to the company. Maybe company can even decide we are not giving dividend at all this year. We are planning to use this 1 lakh crore completely for making the company even better. So it is up to the company. Used in a sentence as, I have 1,000 stocks of Reliance and I received a dividend of nearly rupees 8,000 in the last quarter. Amazing, right? The next term we are learning is portfolio. Portfolio is nothing but the basket of stocks owned by a person. Right. So I might have 20 stocks in my portfolio. You might be having 7 stocks in your portfolio, right? So based on our understanding or our liking of stocks, we might buy stocks. So whatever group of stocks that we have is called portfolio. Now used in a sentence here as, my portfolio has 20 stocks, out of which there are 10 large cap stocks, 7 mid cap stocks and 3 small cap stocks. See? In used in a sentence, now I am even using terms that we learned in the previous slides. I hope that will help you learn even better. Moving ahead, the next term we are learning is CAGR. CAGR, the full form is compound annual growth rate. Now, CAGR is a number. It's in percentage, okay? It's a percentage number which is used to measure the pace at which your portfolio is growing. See, we all invest into stocks and we all will have our own portfolio. So it is very, very important to measure how much or at what pace is our portfolio growing every single year. Now, for example, used in a sentence here is, Nifty has given a CAGR growth of nearly 14% over the last many years. Our aim as an active investor should be to grow our portfolio at a CAGR greater than 15% so that we can proudly say that we have beaten the index, right? So CAGR is very, very powerful, very useful to measure the growth of our portfolio. The next term we are learning is position. So if I may revise, portfolio and CAGR is basically used when it comes to investing for the long term. But position is normally used to refer to a trade that you have taken. Yes, no, this term and the following terms would be related to trading activities. Position is nothing but a trade that you have taken. That is it. A trade that you have taken, you can say that I've taken a position. Okay, now the second term here says that it is mostly used to refer to trading activities, both intraday and swing. Now, used in a sentence here is, I took a position in Reliance at 10 a.m. in the morning, which is in profits now, and I'm planning to hold on to the position for some more time. So, position is nothing but a trade that you've taken. Moving ahead, two important terms you as a trader should know are trading capital and deployed capital. Trading capital is the entire money that you have added to your trading account for trading activities. Say you have come to learn about the stock market. You learned that you should have a demat and trading account to start trading. Say you opened an account with Zerodha as well. Now, after opening an account with Zerodha, say you funded it with 1 lakh rupees for trading purpose. Very important, right? For trading purpose only. Maybe for investment purpose, you would have put another 1 lakh rupees. Let's not take that into consideration. For trading purpose, if you would have added 1 lakh rupees, that is called your trading capital. Now, the next term here is deployed capital. Deployed capital is the money that you have used to take a specific trade. Now, when we read the used in a sentence, you'll understand this even better. My trading capital is rupees 1 lakh. And my deployed capital in the Reliance position is rupees 25,000, which is 25% of my trading capital. For example, when you have 1 lakh rupees as your total trading capital, never ever deploy the entire trading capital into a single trade. Now, this is called position sizing. We'll learn about position sizing moving ahead. No worries at all. Basically, if you have 1 lakh rupees trading capital, you will be deploying only a part of it to a specific trade. And that is called the deployed capital in that specific position that you've taken. If you've understood, we are moving ahead into the next two terms, which are long position and short position. Again, you'll have a basic understanding of this already. Long position is a trade where you buy first with an intent to sell later. Now, a short position is a trade where you sell first with an intention to buy it back later. We have already learned about short selling. That's exactly what a short position is. The next term is very important when it comes to a trader, which is squaring of a trade. The term is square off. Squaring of a trade means exiting a trade. That is it. Maybe you would have entered into a long position or you would have entered into a short position. If you exit the trade, it is called squaring of that trade or squaring of that position. As you can see here, you sell to square off a long position. Just like that, you buy it back to square off a short position. Used in a sentence here as, I took a position in Reliance at 10 a.m. in the morning and I squared it off at 2 p.m. Now, you know, if it is an intraday trade, if you do not square it off manually, auto square off would happen at around 3:15 p.m. Right? It is done by the broker. We have already learned that. The next term we have to understand is return on investment. Now, ROI is again used to measure how your trade performed. You can understand it is a percentage number again. It will tell you how much returns you made from a specific trade that you've taken. Now, return on investment or ROI, as you can see here, is used to measure the returns in percentage that you could make from a trade or that you already made from a trade. The formula here is ROI is equal to profit from a trade divided by capital deployed in the trade. Used in a sentence as, I took a position in Reliance at 10 a.m. in the morning, I squared it off at 2 p.m. The trade gave me an ROI of 2%. How amazing, right? Moving ahead, the next term is contract note. Now again, this is something which a lot of beginners do not look into. This is very important and I urge beginners to actually look into contract note. Then what is a contract note? It is a daily report of all the trades that you have placed and all the charges incurred in your demat account that the broker sends to you in the evening via email. Okay, this is a PDF document that the broker sends to you via email every single day. If you have traded, the broker will send you contract note via email. Beginners do not check it, but you should check it. Why? So that in the contract note, if you open it, you can see all the trades that you have taken, how much profits and loss that you made in each trade. And more importantly, you can also see all the charges that the broker charged you in that specific day. Used in a sentence here as, I checked my contract note and it showed a brokerage of rupees 20 was charged for my trades. Moving ahead, the next term we are learning is trend. Now again, there is a very famous saying in the market, trend is your friend. We'll understand about that later when we learn technical analysis. No worries at all. Now, what is trend in very simple words? Trend is nothing but the general direction in which a stock is moving. Now, there are three trends which are available, right? Number one is uptrend. Number two is downtrend. Number three is sideways trend. It's kind of literal, you'll easily understand. Now, if a stock or the index, which is Nifty, if the stock or index is moving up over a period of time, we can say that it is in an uptrend. If the same stock is moving down in a specific time period, we can say that it is in a downtrend. In the third case, if the stock is not moving up, it is not moving down also, it is just staying in a specific range only, we can say that the trend of the stock is sideways. Now, I'll show you pictures here. You can see the picture and you can understand what uptrend, downtrend and sideways trend are. Used in a sentences, the stock is in a strong uptrend now despite of Nifty being in a downtrend. Here, Nifty is in a downtrend. Even then, the stock that we are looking into is in a very strong uptrend. So, this is a very, very good use in a sentence example, right? Moving ahead, these are terms I'm sure a lot of beginners, not a lot of beginners, all beginners, or even if you haven't come into the world of stock market, you would have heard about these terms, right? Bullish and bearish. Now, these are very simple. Let's quickly understand them. The term bullish is used to refer to general uptrend in a stock or the general market. Now, say a stock is in a strong uptrend, or say Nifty is in a strong uptrend. We can say that the stock is bullish. See, we can also say that the stock is an uptrend. At the same time, a different word to be used there is, we can also say that the stock is bullish. The opposite of that is bearish. If the stock is in downtrend, if the stock is moving down, down and down, we can say that the stock is bearish. Used in a sentence here as, market was in a bull rally for more than a year after it crashed during COVID times. I hope all of you remember this, right? In the March, April times of 2020, the market crashed because of COVID, right? After that, for more than a year, we saw a stellar bull rally in the market. Overall, the general market and almost all of the stocks were moving up with a lot of strength. That's where we say the market and stocks were in a bull rally. Now, I'll give you why the terms bullish and bearish came into existence, right? Very important to understand. Say, bull as an animal, it takes down its prey by hitting it into the upper side, right? You can see the picture here, right? That is why when the stocks move to the upper side, it's called bullish. And a bear, the animal bear, it takes down its prey by hitting it to the downside. You can see the picture here, right? That is why when stocks move downwards, it is generally called bearishness. Cool. The next term we are learning is volatility. Now, volatility is if the market is not stable and it is making frequent big moves on any direction. Say a stock, it is moving up on a day, then it's coming down a lot in the next day, then it's moving up, then it's staying there, then it's moving up, then it's coming down again. So, if a stock is not stable, it's moving here and there a lot, making violent, big, frequent moves, then we can say that the stock is volatile. Used in a sentence here as the stock is bullish but also very volatile. It is moving a lot in either directions, right? The next term we are learning is volume. Very important to understand. Volume is the number of share transactions done in a time frame. That is, for example, if the time frame selected by you is 1 day, then the total number of share transactions done in Reliance would be the volume in Reliance in that day. Say 1 lakh share transactions were done in Reliance on a day, then 1 lakh is the volume of Reliance in that day. Used in a sentence here as, today at 11 a.m. there was a huge volume in Reliance after the news came out that Reliance is getting into the space industry. Now, this is just a funny example that I've taken, but you understand the fact that when such a news come out, a lot of people would want to buy Reliance, and maybe a lot of people who would have bought Reliance at a very lower price, they would feel like, okay, now since there is a huge demand, let's sell at a very high price, and they might sell also. And because of that, a lot of transactions might happen then when such a news come out, and we could say there was huge volume in Reliance. Got it? Then let's move ahead into the next term, which is liquidity. Now, liquidity is when there is high demand and supply readily available for a stock. That is when we say there is high liquidity. When there is high amount of demand and supply readily available in the market. Now, the opposite of liquidity is called illiquidity. Now, for example, when we look into used in a sentence, you'll understand this better. If you own a stock and if that stock is illiquid, it would be difficult to sell it, right? That is, if it is illiquid, it means that there is no demand and supply in the market. So even if you want to sell it, there is no demand at all. You wouldn't be able to sell it. You would be able to sell it only when a buyer comes in. and you never know when a buyer might come in, right? Because the stock is illiquid. Now let's talk about large cap companies or even mid cap companies. Those are all liquid, which means that always and always there would be high liquidity in the market, which is demand and supply is always available in the market, which means that whenever you want to buy, you can buy the stock. Whenever you want to sell the stock, you can sell the stock. So always go for high liquid stocks. Cool. Let's move ahead to the next term, which is charts. So I'll show you a chart here, and then you can understand the fact that chart is the graphical representation of the price movement of a stock, because a stock moves, or the price of a stock moves on a daily basis. In fact, it moves on a second to second basis as well, right? So when you look into the graphical representation of the price movement, you can actually understand that, okay, over the course of last 1 year, how did the price of this stock move? Was it on an uptrend or a downtrend, or was it consolidating? You will understand everything only if you look into the graphical representation. Otherwise, what you're seeing is, okay, Reliance is at 2,500 today. What are you understanding? But if you look into a chart, you can see that, okay, over the last 1 year, it moved up from 1,500, then it went up to and created a high of 2,850, then it came down to 2,000 again, then it went back up. So you will understand the history of the prices only by looking at a chart. Used in a sentence here is, check the chart of Reliance. It looks bullish. Right? So trend of a stock can be confirmed only if you look at a chart. No worries if you do not understand a chart here. Going ahead, when we learn technical analysis, we'll understand everything about not just understanding charts, but also analyzing charts. Looking forward to that for sure. The next term we are learning is 52 weeks high or low. Now this is a very literal term to understand, so let's quickly read that, right? The highest price made in the last 52 weeks is called the 52 weeks high price. And the lowest price made in the last 52 weeks is called the 52 weeks low price. Now, why 52? 1 year consists of nearly 52 weeks. So that is the relevance of 52. So normally 52 weeks high tells us the 1 year high of the stock. Now used in a sentence here as the 52 weeks high of Reliance is around 2,850. So we know that Reliance is at around 2,500, 2,600 now. Now the 52 weeks high is 2,850. Now we know that in the last 1 year, Reliance had gone up till 2,850 and now it has come down to 2,500. So that is one information that 52 weeks high and low tells us. The next term we are learning is upper circuit. Very, very important for beginners, right? Upper circuit is an upper limit level for price movement in a stock to prevent huge movements and manipulation. Okay, this is very important to understand. Just hear me out. Okay, so stock market is a world where a lot of people come with a lot of greed, and there are high chances for manipulations and operations as well. And for that reason, NSE and SEBI decided that there would be an upper limit to how much a stock can move in a day. A stock cannot move further up from that level. It is good, right? So if no such upper limit is decided, a stock can move even what, 50-100% in a day? Is it good? No. Then the stock can be under operations and manipulations. There are some catches here. If you look into the third point, I want your focus to be on the third point. You can see the fact that for non-FNO stocks, now what are non-FNO stocks? These are stocks where futures and options are not activated. So there are stocks where futures and options are available. There are stocks where futures and options are not available. Out of the thousands of stocks available in the NSE, only for nearly 250 stocks, futures and options are made available. The list of the stocks are given here. The link to the same is given in the description and pinned comment also. So for non-FNO activated stocks, upper circuit is fixed at preset levels like 5%, 10% and 20%. Now the NSE decides this. That is, NSE says that for certain non-FNO stocks, the upper circuit is 5%. In those stocks, if the stock moves up till 5%, then it gets locked there. It cannot move up further from 5% on a specific day. The next day, it can move up again another 5% maybe, but that day it gets locked at 5%. It can come down if it wants to, but it wouldn't move up from 5%. For another certain set of stocks, the upper circuit can be 10%. Such stocks can move up only 10%. It cannot move up further from there. And for another certain set of stocks, the upper circuit is set at 20%. Now the limit, which is 5 or 10 or 20, is decided by the NSE, and to understand which stocks have 5%, which stocks have 10%, and which stocks have 20% upper circuit, you can again check the link in the description down below, right? Now, the next catch is when it comes to FNO stocks, because it is very different when it comes to FNO stocks, because FNO stocks are very large, huge volume is there, huge liquidity is there. It is very, very difficult to manipulate FNO activated stocks. For that reason, the upper circuit is not a fixed one in FNO stocks. That is what you can understand in the second bullet point here. Upper circuit of FNO stocks is at 10%. For all FNO stocks, it is at 10%. And when an FNO stocks moves up till 10%, it gets locked there. It cannot move up, but only for some time. For some time, it gets locked at 10%, after which the lock is released, and if there is even further buying in the stock can even move further up. It can then move up till 15%, then it gets locked there again. It is locked there for some time, then the lock is released, trading is resumed, and even then if there is huge buying in the stock, it can move up to 20% and it can move further from there as well. I hope you understand the point. Now, the used in a sentence here is Reliance moved up 10% today and got locked in the upper circuit. Later, it actually came down from there and closed the day 7% in the green. I hope this is very, very clear. Now, if this is clear, you can easily understand what a lower circuit is. Lower circuit is just the opposite of upper circuit, right? There is a lower limit set to stocks so that lot of manipulation is not done to take stocks down to a very, very low level. That is what a lower circuit does. And it is just like that in non-FNO stocks, there is a preset level like 5, 10 and 20%. And in FNO activated stocks, it is just like that. There is minus 10%, it gets locked there, and then it can move down further from there as well. Used in a sentence as Paytm shares fell to its 20% lower circuit today after bad results were published. The next terms we are learning are gap up and gap down openings. Very, very important, right? Because I have seen beginners coming into the market, they look at charts of maybe Nifty or stocks and they do not understand one thing, which is gaps being formed between closing on one day and opening on the next day. As you can see here on the chart here, Nifty closed at one level on one day. The next level, it opened with a gap down. There is a gap between the closing of one day and the opening of the next day. And if you see here now, here you can see one day Nifty closed at one point. The next day it opened with a gap up. A higher gap created between the closing of one day and opening of the next day. Beginners do not understand this. For some reason, beginners feel that price movement continues in a straight line, as in it's always connected. The closing of the one day and the opening of the next day should be same. See, it can be same on some days, but there can also be gaps on some other days. Here, if the opening price of one day is higher than the closing price of the previous day, it is called a gap up opening. If the opening price of a day is lower than the closing price of the previous day, it is called a gap down opening. Now, the question here is, why do gaps happen? How was it created? Now, the answer is very simple, right? In the last video, we learned about AMO orders. Aftermarket orders, that is, retail participants and even institutional participants can place AMO orders which are placed after the market has closed. And just like that, in the morning, there are institutions which place bulk orders as well based on whatever the market sentiment and market news are. Now, from the time of 9 a.m. to 9:08 a.m., when does the market open? At 9:15 a.m., right? From 9 a.m. till 9:08 a.m., all these AMO orders and the bulk orders, all of these orders are matched and price discovery is made. So based on whatever demand supply logic is there between all these orders which have come, and these are matched from 9 a.m. to 9:08 a.m., based on whatever price discovery is done, based on the demand and supply in those orders, a new price discovery is done. And that would be the new opening price of the stock for that day. Right. Order matching is done based on normal demand and supply, and an opening price is discovered. And this opening price can be different from the previous day's closing price, or it can even be same as that of the previous day's closing price. Used in a sentence here as Reliance opened with a 5% gap up after the Jio announcement. Why not, right? Now, we discussed about closing price here, and that can be the last term that we learned today. What is the closing price? Now, here again, I see a lot of beginners get confused. Because if you look at the actual LTP of a stock, last traded price of a stock at 3:30 p.m., you see something there? That wouldn't be the same as the closing price of the stock that day. Very interesting, right? Normally people think that whatever is the price of a stock or even Nifty or Bank Nifty at 3:30 p.m., that would be the closing price of that stock on that day. It is not the case. At any other point of the day, the LTP is actually the share price. But at 3:30 p.m., the LTP is not actually equal to the closing price. So that's exactly what I'm trying to convey here. Closing price of a stock might be different from the last traded price of the day. As you can see here in Nifty, right? What is the closing price you see? And what is the LTP at 3:30 p.m. you see? Those are different, right? So that is where the logic comes in. How is the closing price determined? Closing price of the day is the average price of the last 30 minutes of trading with weightage given to volume. That is, from 3 p.m. to 3:30 p.m., whatever price trading happened with the weightage given to volume also is how a closing price is decided. Sounds a bit complicated? Do not get into it. Just know the fact that LTP at 3:30 p.m. and closing price can be different. Do not get confused when you see that on a chart when you look at it. Now the use in a sentence here is the closing price of the stock is rupees 1005 even though its last traded price at 3:30 p.m. is 1007. Cool? That is how a closing price is calculated. Now we have come to the end of this video. I've taken nearly 40 terms which I felt that all beginners should necessarily know so that you can even learn better. Because as I said in the introduction, you will be learning from other videos as well. You will be reading other literature, other content as well. And I want you as my students to understand all of those things without any problems at all. So what was my ask in the beginning? If you heard this so much, if you understood the terms, good. If you did not understand the terms, listen again, I'm sure you'll understand. Now, if you understood, did not understand, then turn to understood, then I want you to go into Google and then Google each of these terms and read whatever definition is coming there. You'll have a better understanding then, you'll become a better stock market participant then. So that is it from my side in this video. If you have liked the video, make sure that you smash the like button, and something that I do not ask a lot, please subscribe to the channel, and also make your friends and family subscribe to the channel as well. Share the video with them, invite them into our community, into the revolution that we are building here, right? Speaking about the community, if you haven't joined my exclusive community that I run on marketfeed, the link to join is given in the pinned comment and description. Just fill out the form, download marketfeed app, you can join my community. We host regular live Q&A sessions there. Every Mondays, Wednesdays and Fridays, I come there along with my team and we have live Q&A and discussion sessions there. You can ask me questions directly. Also, make sure you jump into the comment section and ask whatever doubts that are on your mind. So that is it from my side for today. Let's learn, invest, trade and grow together. See you in the next class. Bye-bye.